Welcome back to the show. I'm Ozbourne Foreman, and this week has really tested the power of the portfolio. Boohoo has had some news, but there is not much else. And this is because a lot of the companies I now own are very boring, and they don't typically get featured on the news week to week, which I actually think to be advantageous as they're quietly earning money in the background. However, if you would like me to talk about some bigger news in the UK market, then please consider dropping me one of these for the YouTube algorithm. With the S&P 500 currently reaching or very close to the all-time highs, it is slightly concerning. Whilst yes, the UK markets fundamentally aren't as overvalued compared to that of our US cousins across the water, I am still concerned, and therefore I'm now starting to prepare further for another crash in the future. And I'm going to show you some of the techniques that I've used to outperform the stock market. This week, the FTSE 100 is up 2.1%, the FTSE 250 is up 4.02%, and my portfolio is up 7.54%. And now the portfolio in total is up 12.52% since its creation in early April 7th, which is only just trailing the FTSE 250, which has earned 13.19%. I'm already beating the FTSE 100, I nearly doubled it, now it's just the FTSE 250, and then it's time to chase the AIM 100. And I think this is massively due to the rally in Boohoo stock in the last 5 days, but then all of my stocks have done quite well. But I am starting to feel the investor sentiment certainly pile up more on Boohoo, and it could be, well, it might not be long until this stock regains back to £3 per share and then subsequently then £4 per share. Firstly, ASOS, which is another fashion giant located in the UK and a direct competitor with Boohoo, and obviously in the past they had dropped Boohoo from their retailing site due to the whole weak claims of modern day slavery and how it's slightly tied to Boohoo but not really. We've obviously since found that this is a lot of rubbish from the media and their attempt in shaking the tree, hitting investors' stop losses and therefore getting Boohoo at a great price. Anyway, ASOS has changed their methodology for marketing third parties on their retail site and stores. And this effectively means that they're now asking for a commitment from their suppliers. So for companies like Boohoo to be relisted on the ASOS website, they would have to regularly declare their suppliers and obviously their supply chain. And whilst the consumers of Boohoo, which are the younger generation and can't afford to ethically care about where their clothing is from, this is certainly a strong move for that company in regards for investor sentiment and confidence. And honestly, I see this becoming a trend for these fashion companies. And ultimately, it's a very cost-effective way of increasing their PR and therefore keeping their investors happy. And ultimately, this will not impact Boohoo that much as the total of ASOS, Zalando, Next and Amazon combined only took up around 4% of Boohoo's total revenue. So it really doesn't matter if they try that hard to be listed on there, but the biggest point is that they would likely want that loyalty or the respect gained from being on those sites. And Boohoo is now estimated to have only lost around 5% or up to 5% of their total revenue, which is quite a different change from the last time I spoke about one of the analysts that was forecasting total destruction almost. And effectively, this is because of how well they are able to communicate with their target audience using social media. And I've even experienced it myself. They were doing a Twitter giveaway for £100 and they had thousands upon thousands of retweets, which effectively means that they've posted it on their own profiles and shared it to their friends or the followers on their profiles. And I actually have a Twitter account, so if you're interested in that, it is at Ozbourne Foreman, and I regularly post about the portfolio, but I don't spam you with YouTube links. And they've also created various different TikTok videos, and effectively it's a bunch of the younger audience dancing to what seems to be a TV advert song. It's ridiculous, I don't know why they do it, but I can't show it on this video for copyright reasons. However, if you are interested in this, if you Google Boohoo is back TikTok, I'm sure you could find it, and that's a rabbit hole to go down on its own. And this is really good news for the company actually, and I remain very bullish on their potential in the future. And the analyst prediction, I honestly think that's a very conservative prediction and more in line with my beliefs of the company. However, I do believe that they will actually shock a lot of the investors, as typically the people invested in Boohoo are a completely different audience. Whilst yes, this audience would very much care about ethics or how their investment is going to go, the audience that purchase the Boohoo products really don't care. And I eagerly await the report in September in which they'll announce the partial results of their investigation into the modern day slavery links and also update their earnings, which I think are going to be quite good. And I expect to have actually grown further than anticipated and completely shred or completely shrug off the negative PR, because that only reached the type of people that don't even buy Boohoo products in the first place. And now I'm considering buying Boohoo products simply because it was negatively put in the press. Also, the founder of Boohoo, one of his sons, has actually created a property portal. It's very similar or being compared to the likes of Tinder, where you would simply swipe yes if you like the property in, or swipe, I don't know, swipe rights and lefts, but you swipe a certain direction regarding what you think of it. So yes, if you like this property and its price, swipe it and it will therefore go onto your list and therefore technically match, and you can look at it later. I think it is a very good way of actually adding property portal, making it more accessible to mobile applications. And honestly, I think they do have a chance here at taking on Rightmove, Zoopla and On The Market. And there is a chance that this could be subsequently acquired by Boohoo, and therefore they could diversify, not only being a fashion giant, but actually take place in the property market in the UK. And in fact, this goes along with my visions, as I think in the medium term, yes, they're going to continue growing and consolidating and buying more brands in the fashion sector, but I also feel that they are going to expand out. Eventually, clothing isn't going to be it. They're likely going to expand out and compete with the likes of Amazon and eBay. Boohoo's share price has actually increased by 8.97% this week, and is one of the biggest drivers of the portfolio, as I am now up 16.33% or £804 in the green. And this position now takes up 54% of the overall portfolio value. And as I've said in the last episode, in which I revealed my income and my net worth, which if you'd like to see, you can click the card at the top right of the video. But as I had said, I'm not going to be adding more to this position, even if it is at a fantastic value, as systematically I'm way too overexposed to this stock, and it is quite a high risk tolerance I would have to maintain by continuing to purchase into it. As if another stock market occurs, especially in 2020, it's very likely I'm overexposed to Boohoo, and that if they drop a significant amount, then I'm going to be in the red quite hard. And whilst yes, I do think I will be able to cope with the overall volatility, it is still concerning for the mental health and how well I will be able to hold myself together. Although I do think Boohoo will be much more resilient than that of other stocks in my portfolio, as simply as they're already beaten up and battered. I suspect that it can't really go much further, and I've already gotten such a fantastic value on the stock of £2.46 per share. And whilst many of you right now will be piling into a stock which you believe to have fantastic value, it could be even Boohoo, could be Aston Martin, I'd love to know in the comments below, but I would strongly suggest the idea of building up a cash position. And I'm personally now looking to build my cash position, and this is split into two different sections. Firstly, an emergency fund is very important, as we could be in the deepest recession of our lifetimes. I've mentioned that countless times before. An emergency fund will be excellent because if you lose your employment, you can still continue on with your day-to-day expenses. I'm personally going to be looking to build an emergency fund of around 6 months of my expenditures, which is roughly £4,550. And currently I'd reduced it in the past and actually noticed that subsequently I'd had more stress. And this is very much because I don't have anything to rely on. I don't think that my job will be very much impacted, as it is still quite a staple career to be in, but it's not high paying. So I'm going to certainly start building up the emergency fund so that I don't have to sell any of my investments in the case of an emergency. The first step, however, I would suggest is building up your emergency fund to £1,000, and that's exactly what I'm going to do. And the second cash position actually relates to one of my investments, a stock called Ashted Group, and I'd spoken about them before, and I'd actually been buying more this week. And the reason I was able to buy more is because I had a cash position on the outside of the portfolio. I was able to successfully average down when the stock was down around 5% at the start of the week. Subsequently, they have rallied, and I managed to get a fantastic price on them of around just under £25 per share. And I'm now in the green by around 2%, and I was able to buy another 7 shares of this stock. And this second cash position is the idea that you should have cash for your investments sat outside of your portfolio and left, so that if there is a correction, a crash, or something concerning in the stock market, you are ready for it. And that's exactly what I'm going to be doing and building up. I want this personally to take up around 10%. 10% is a fair figure, as I don't think it's too much. It does mean I can keep investing as much as I get. But then that 10% is there if there's a crash, because then I can go in, jump in, grab this stock at a discount, grab that stock at a discount, and add to my positions overall. And I personally will not touch it unless I see a nice value to average into. Bringing my overall total to 33 shares of Ashtead Group, or my position size to around £860 of equity, or approximately 8.3% of the total portfolio, which is actually currently underweight, as I am aiming to have it as a 10% position of the portfolio. One of my strongest strategies in preparing for the next stock market crash is actually mentally. And so what I have done is written down my reasons for owning each and every stock that I own, so that I know if the market does drop, whether to sell this investment or whether it's actually trading below intrinsic value and subsequently to buy more, as it really matters in whether I should be cutting my losses or acquiring more at a fantastic discount. It also means that my sentiment is higher. I'm less likely to panic and think, right, I've got to sell this investment, I don't believe it anymore, and you've just lost 40% of your overall value of that investment. And in fact, London Stock Exchange Group is a prime example of this. Whilst I've only recently acquired it in the last 2 weeks, I think this is an excellent stock to own, and I've actually written this down. And this is a stock that I will continue to purchase because I see interest rates remaining fairly low for the medium to long term duration, and therefore stock valuations are subsequently cheaper, and therefore they're going to see a benefit from increased amount of people investing in the stock market and more traders, especially if there's more volatility to come, and that they'll also benefit from the possible acquisition of Refinitiv, in which they're looking to weigh up selling their Italian arm, which I think would be a fantastic trade if they remove their Italian arm and buy Refinitiv, as they're an excellent media company that provides stock investment analysis for thousands of, like tens of thousands of different clients around the world. And they've previously had excellent management. They've also been passed by the EU regulators, meaning that they are definitely a legitimately and well-placed company, and therefore I really believe in the stock and will continue to hold it. Currently, I own 15 shares of London Stock Exchange at an average price around of 8,429 pence per share. And they are also subsequently underweight in my portfolio, only taking up 12.2%, in which in the future I would like to take up 15%, although this is massively due to the fact that I'm massively overexposed to Boohoo currently. That's why it's subsequently lower. However, this stock typically rises and falls with the general market, which actually isn't a bad thing to have, but it basically means that you won't really see much gains in either direction unless when they release their earnings and subsequently they've done fantastically well, or potentially in the future acquired Refinitiv. But in fact, it also means that what happens is that when the market goes down, that they really shrug it off and barely lose much value, if at all, making it a very staple defensive stock in the portfolio. And actually, LSE is only up 1.82% this week, which is actually my lowest or weakest performer in the whole portfolio. 60% of you watching this video right now aren't subscribed, so please consider subscribing, as it doesn't cost a penny and is ultimately free. Thank you. Another huge factor to take in place is taking the time to reflect on your overall risk tolerance in regards to your portfolio. And I think it is another fantastically important step in preparing for the next crash, as I found that whilst looking at my higher volatility stocks during the week, that my heart could be pounding if they've dropped like 4-5%, and it's suddenly like, whoa. And it really like disrupts your rhythm, even if it is like a short-term like shock. And in fact, I've actually noticed the key signs of stress, such as clenching my jaw, potentially even grinding them. I've woken up with my teeth like properly clenched, the tensing of my muscles in my body. However, I do suspect this is a combination of the fact of my portfolio being quite risky at the moment, combination of working inconsistent working hours, which are improving, and also a combination of the stress and pressure of getting YouTube videos done and uploaded, and also the fact that my emergency fund is very weak at the moment. And currently my overall beta volatility of the portfolio is 1.348, meaning if the stocks dropped, or if the stock market dropped 10%, my portfolio is going to be down 13.48%, which is quite scary to think about, as the more the market drops, the more my stocks are going to drop too. Whilst I could say now, yes, I'll be able to manage it. Maybe at the time I won't be able to. And what if I end up panicking and selling out? I do plan to reduce this in the future, in which I'm going to be reducing it to around 1.15 to 1.2, which is still more volatile than the market, which means I can get more upside and downside from it and more buying opportunities, but also not as high as it is currently, as it can swing rapidly in either direction. And so actually I plan on averaging my money into more defensive, lower volatility stocks with consistent dividend incomes, such as Halma. Halma are a defensive technology stock providing solutions in engineering, environmental and health solutions in the market. And this is actually, in fact, the only stock that is down in my portfolio currently, which is quite incredible to think about, although I did cut my losses in previous investments. I'm down a huge 0.19% or 65 whole pence of losses. I can't take it, this is too much. I currently have an average price per share of around 2,250 pence per share and currently own around 15 shares, which gives me my total equity of £336 and is also subsequently extremely underweight, and I need to add 6.8% of the overall portfolio value into this position in order to get my goal of 10%. And I'm going to be doing that over the next few months as I average in and slowly build up this position like I had been doing with Ashted Group. Softcat is my other low beta volatility stock, boasting a beta volatility of 0.51 and is by far my most underweight position in the whole portfolio, as I actually in fact want it to take up 15% and currently it takes up 0.3%. I know, this isn't good, but I'm going to be buying into this as well as Halma, depending on which I see to have the most value at the time of purchase at the start of each week, for instance. And due to my concerns about a potential second wave, the ongoing Brexit deals, and the fact that the date is incoming and we still haven't really made any deal whatsoever, I'm going to be loading up on this stock in the near to short-term future and be ramping up to 15% as I said, as it is once a defensive stock and also has a lot of growth potential in the UK and furthermore globally. But probably the most important method in this whole video, so if you take one thing in, take it in right now, about preparing for a stock market crash, is the idea of setting wish list for the stocks you want to own. And you may think, why is this so important? Well, if there is a market crash, you will like to know a reduced list of stocks that you really like but just felt they were a little bit overvalued. And this will present you fantastic buying opportunities for the future, providing you have that cash position on the side. In the past, I've suggested the idea of price targets, and this is great in the short term. However, it's very unlikely that we don't have a crash in the next 1 to 3 years that the price target is going to be irrelevant. So you should look for stocks, put on your wish list, and set a valuation that is fair for you using other metrics. And a prime example of this is my stock in my portfolio, All Games Workshop. And without missing a heartbeat, I would purchase this stock on any weakness, especially at a subsequent discount. And I will likely be averaging into this stock every single day. I only currently own 25 shares, and this gets a little bit complex because it takes up 23.4% of the overall portfolio, which means I am technically overweight. However, I want it to take up 75% of my overall Boohoo position, which I expect to come down with time as I don't really plan on averaging more money into it, which would effectively mean I'd have a 30% overall position in Boohoo and a 20% position in Games Workshop. As I've said before in previous videos, I think this is one of the best stocks in the whole of the UK market. And my average price per share of this stock is 8,164 pence per share, and it's currently trading at 9,470 pence per share, meaning I'm up around 15%. And if you're interested in my Brexit stocks to buy, then click the card at the top right of the video. Thank you for watching. This is the Ozbourne Foreman Show. See you Tuesday at 4 PM with my next stock analysis.